Welcome back to Commercially Speaking, the only commercial real estate podcast where a former Marine Arabic linguist tries to teach commercial real estate to an improv comedian who, in our last episode, learned that LTV doesn't stand for Lala TV.
Yeah, not even close.
I'm Timmy Barron, ADHD, actor, comedian, and Bo's personal stress inducer producer.
And I'm Bo Barron, CCIM, co-founder of the Hearthstone Capital Fund, owner and director of the Barron Commercial Group, CCIM instructor, and the only host on this podcast who's ever balanced a T-12 or a rifle.
Speaking of rifles, today's guest once wore a Green Beret, which, for those of you who are not familiar, let me explain. Bo, what do these films have in common? Sands of Iwo Jima, Full Metal Jacket, Heartbreak Ridge, Lone Survivor, and A Few Good Men.
They're all movies about Marines, except for Lone Survivor.
They're all Academy Award nominated movies about Marines, except for Lone Survivor. Now, what do these films have in common? Beards of Village Drama, Soft Flannel Beret, Soft Skill Hill, Soul Advisor, and A Few Mild Chaps have in common.
Oh, no.
These are all screenplays by Army attempting to replicate Academy Award nominated movies about Marines.
In other words, doing Marine stuff on an Army budget.
That's my brother.
But real talk, when a Green Beret has something to say, you shut up and you take notes.
Exactly. Otherwise, you won't be able to hear them. Our guest today is Quinn McArthur. And yes, that is his real name. Not a bourbon brand, not a Marvel villain, not an outlaw cowboy reboot, even though he's got the intensity of all three. West Point grad, Green Beret, husband, father, faith-driven entrepreneur. Now he runs Legacy Land Fund, managing millions in land-backed mortgage notes with zero outside leverage. And to be honest, I have no idea what that means, and I'm not sure I trust it.
That's why I'm here. Quinn's bringing the kind of conservative strategy commercial real estate needs right now, plus the kind of backbone you can't teach in a finance course.
So buckle up, pour yourself a glass of something patriotic, and prepare to meet a man who makes land investing sound like a moral calling and a face so handsome he should have been a Marine. Please welcome to the show, Quinn McArthur.
8, 7, 6, 5, 4, 3, 2, 1.
Man, I appreciate that, guys. Well done.
Absolutely. Absolutely. So how do you two know each other?
Yeah, how did we get connected?
I don't know.
I don't remember.
I don't remember.
Oh, yeah. Okay.
Good story.
Great. Well, that's
It was, no, I think it was
I don't remember who connected us. Somebody
was it
did.
Cole? I thought it was just a mutual friend that we knew that was kind of in commercial real estate. I do a lot of land investing, but also a lot of commercial. So probably someone from the commercial world.
That's probably true. But however it happened, we jumped on a call, and we can get into this here in a minute. But like Quinn's a land guy, and you know what land is?
I know land.
Boring.
We've talked about this before.
So I'll get into what I asked him about. But man, let's dive into his background a little bit.
Oh yeah, I'd love to.
He's got a unique on-ramp into commercial real estate.
Yeah, Quinn, let's do it. Let's give us a little background and then how you landed into where you're at too.
Landed into the land.
Landed into the land.
Man, when I was getting out of the Army, kind of like a lot of people didn't really know what to do. A lot of folks were going back getting their MBAs and stuff. It seemed like a good route. So I was going to follow that path. But then a few friends convinced me to jump into commercial real estate. So I took their advice and really never looked back, honestly. So was working for some development and investment shops and did well and was looking for places to park capital and grow it and earn some passive income, and actually through an Army mentor of mine that showed me what he was doing with land investing, and he was doing really well, and not working very hard for it, honestly. And so I asked him how he was doing it. So I co-invested with him, and really the rest is history. Just did more of that and continued to double down and learn and grow and network in the land space to the point where we're running our own investment fund now, solely focused on land. So kind of an interesting little niche. So it's kind of coming from the traditional real estate, but doing something that's not quite traditional now these days.
Yeah. Well, part of your background is that you were, of course, a Green Beret. We alluded to it in the intro.
Yeah, we just touched on it.
But like, explain to Timmy what Green Berets do, because in the special forces community, like SEALs kind of have the things that they're really good at. Rangers have the things that they're good at. You know, you got some of these other special forces, but Green Berets have a very specific mission, and frankly, I don't know many people who really understand what that is.
We just do what the SEALs and the Marines do, and you just do it better.
I figured something like that was coming.
Yeah. No, it's really, it's a lot of it is, it's kind of, so we train indigenous forces to kind of fight their own wars. So we do a lot of like training, foreign national, forces to kind of, fight their own battles, and we partner with them. There's a lot of unconventional warfare in there. And, but then you also have the direct action component as well, like the Rangers, like the, Force Recon and the SEALs and stuff like that. So it's a varied skill set, and so each team kind of has a variety of skill sets on any one team. So you can really get dropped into any mission set and hopefully be successful because of kind of the wide spectrum of skills and abilities on just a small 12-man detachment. Yeah, so each group kind of has their own area of responsibility, and you kind of focus on that culture, that language, and go deep on that, that specific group, and then that's where your mission sets are.
What led you to go into the military in the first place?
Well, probably, I wish I could say it was for a sense of duty, but honestly, it was more selfish than anything. At least that's the way it started.
Same for me. Yeah, for sure.
Yeah, it was just seeking adventure, kind of going this way when everyone was going that way. So when I went to West Point, I knew nobody that was applying. So I'm like, that sounds good. That sounds like right up my alley, because nobody, so it was more just adventure. And I had some family friends that were cadets at the time, and it just kind of saw what they were exposed to, and kind of saw the impact that they were having with their platoons and their companies. And I thought that, hey, maybe I can do that.
When you say cadets, is that specific to being a Green Beret?
Cadets? No, cadets a West Point student.
Yeah, okay.
In any academy or in ROTC, they're cadets. They're kind of officers in training, if you will, until they get their commission, and then they enter the Army or the military service as an officer.
Gotcha. So what was the bridge that took you into becoming a Green Beret, or was that and when you went into the Army, was that the purpose, or?
I kind of did. Yeah, I always had my sights set on it, but in the Army specifically, you kind of you go to the regular Army, so you serve in, particular branch. For me, it was infantry. You can come from any branch, but after a handful of years serving as a platoon leader or in whatever capacity in your particular branch, then you have the opportunity to go try out basically for special forces. And that you go through that training for a few years, and if you're successful, then hey, here's your beret, there's your unit, let's get after it, and here's your mission set. So you go to like a specific Green Beret or special forces unit once you've kind of passed all your, qualifications.
Gotcha. Yeah, because if I was, I come from a military family, as in both our dads were in the Army. I mean, both our granddads, both our dads. We have a mom and a dad. Both our granddads were in the Army, and they fought in World War II. Dad was in the Army and was recruited during Vietnam. Bo was in the Marines. My other older brother was in the Marines. I always have a joke that I popped out left-handed and went to art school instead. But so for me, like I did consider going into the military. And
Really?
yeah, of course, mom and dad talked to me about it. Right. And they thought it was every young man's duty to do it.
Sure.
Right.
Too late. It's not too late.
Right. So I had to consider it. And I was like, And then National Guard came in, and their obstacle course that they set up at the school was the coolest. And if I would have known about the and I was in the band, so I played French horn in the marching band. And I heard that from Bo and Jay that anybody the Marine band is up there. That's like the president's band, right? It's amazing. But at boot camp, anybody who joined the Marines to be in the band were just ripped apart at boot camp. I was like,
that's very true.
Yeah. And so I was like, no, I don't know if I want to do that. But if I knew, because I found this interesting, I just learned this researching it yesterday, that Green Berets really don't have to shave like the rest of the military, that I would have considered that. So
hey, that was part of the appeal. I won't lie. There's some relaxed grooming standards, as they call it. So yeah, you got to try to fit in and not look so
white American. Yeah.
Yeah. Exactly.
Right, and that makes sense. That makes sense, and that's what. So I found that out, and then I saw your picture. I was like, oh man, this guy's got a face for the Marines, not a beard. He can't hide that behind a beard. Anyway.
Well, I'm interested to hear about this mentor that you had that got you in the land, because my experience in the Marine Corps, first off, I was on the enlisted side, which I'm sure is very different. But I didn't run into anybody in my 5 years, 4 months, and 2 days that was doing real estate. The fact that you had a mentor that came from the Army is a little surprising to me, but I wonder, how did you connect? How did that happen? And was that more normal on the officer side or in the Army, or was that just kind of a providential?
Yeah, actually, I didn't meet that mentor that I'm referring to until I was out, actually. He just coincidentally, when I got out, I was at Eglin Air Force Base over in the Panhandle of Florida, and he was retired. He was living in Pensacola, right down the road, and I can't remember how we initially linked up, but he was. I kind of made him my mentor. So it wasn't anything like the Army set up or by virtue of being an officer at all. It was kind of like I kind of heard or saw what he was doing. I'm like, hey, dude, teach me. You're gonna mentor me, please. If you don't mind, So it was more like that. It was more like a friendship, and not it didn't come out of the Army per se. But that said, though, I mean, there's certainly tons of awesome mentorship relationships that I had with some of my commanders. I was fortunate to have some pretty awesome guys kind of leading our units that I could ask anything to. They're like brothers, honestly. Yeah. And I think in special operations community, it's less hierarchical. It's a little more relaxed, right?
Yeah.
Yeah. So it's they're my superior technically, but we'd hang out, So.
And so you saw this guy in Pensacola doing land, and you touched on this just a second ago, but let's go a little deeper on what was it about land that was it just he was out there on the pool all day long, baking in the sun?
So it was because
Hey, if you're new to commercial real estate investing, you probably know the feeling. Brokers, underwriting, raising capital, where do you even begin? And that's why CRE Investor Coach exists, to give new and emerging investors a clear step-by-step path to closing their first deal. I believe in this program so much, I actually joined the team as an adjunct faculty member. That's how committed I am to helping more people get into the space right now. Whether you want to go at your own pace with on-demand training, launch your first investment investment with expert coaching, or scale with a mastermind of other ambitious investors, there's a roadmap here for you. Inside, you'll learn how to define your investor identity, analyze deals with confidence, talk to brokers like a pro, raise capital, and build a real acquisition pipeline without all the guesswork. This is about building a business that blesses your life, not breaks your spirit. So if you're ready to stop spinning your wheels and actually get in the game, check out the link in the show notes and start your journey today. Learn, launch, and scale with CRE Investor Coach. This episode is also brought to you by Site to Do Business, commercial real estate's most advanced toolkit, providing commercial real estate professionals like me with premier data, mapping, and marketing tools to win business and revolutionize decision making. Visit stdb.com to learn more.
When I got out of 7th group, I was working for a developer, and like we were working hard. Like it was hard work. We were building homes and managing like larger like multifamily asset classes, retail asset classes. Like, man, that's a lot of work. There's a lot of risk. And a lot of time. And then I saw this guy who was deploying capital safely, making investments, and earning a return very, very passively. And at the time, I was like, how is this even legal? Like, this is crazy. Like, how he's a real estate guy, but he's not really working nearly as hard as I am. And that was just like really eye-opening that you could, use your money to make money. And so I was like, I'm intrigued. I like real estate. I don't know a lot at the time. And it's so that was the appeal. I was like, dude, this guy's doing something completely different than kind of the traditional buy, hold, rent, sell at a low cap rate. Like it wasn't really any of that at all.
Let's kind of transition, because look, you've been on the development side, you've done traditional syndications. I remember asking you the first time we spoke, like, explain to me this land thing, because when I think about investing in land, it's like I go instantly comatose. It just sounds and feels boring to me. And then we had this conversation about what you're doing that is very much not boring, but there's a tremendous amount of freedom that comes from what he's doing. There's stability, amazing. freedom of time, there's a lot of,
And it seems too like, it's almost like not a lot of people know about it, because what you were talking about and what I saw on the website, I was like, how do not more people know about it? Which kind of works, being a Green Beret as well. Not many people know about that either.
Mm-hmm. So tell us about Legacy Land Fund. Like, what is this thing? What are you doing?
Yeah, well, you're right. It is a niche, and I'm surprised too, Timmy, when I'm like, I'm surprised there's not more people coming into this space, and part of me is like kind of good, like less competition, right? But at the same time, I'm happy to, there is an abundance of deals, and so I'm always happy to kind of share with whomever that is interested in what we're doing.
That's good, because this is a podcast.
This is a podcast. But I can be careful what I say. There's so many like strategies within land. What my mentor friend was doing was he was doing it like buying land and like taking title to it and like subdividing it and selling it. So it was passive in the way that he didn't have tenants and maintenance issues, but he was still taking title. He was still like fairly active, doing due diligence on this land and basically flipping it. But yeah, you're right. Most people's conception of it is like, oh shoot, you're a land investor. So okay, so agriculture. So your tenant is a farmer, or like where's the revenue coming from? And it's actually none of it's or you're harvesting timber. That must be it. So it's like, well, no, I don't have tenants and I don't have timber. I'm actually, what it is, I think the easiest way to explain what we do is basically we are the bank for people who want to own land. So instead of, like you have a mortgage company that holds a mortgage for your home that you live in, and you pay that institution, that bank, that lender, principal and interest payments. We do the same thing, but not for homeowners, for landowners. And so it's a private it's more of a, it's honestly, it's more of a banking strategy than it is a real estate strategy. It's backed by real estate. So it's backed by the land. That's our collateral. That's our security. But but I wouldn't, I mean, there's really not a lot of like execution happening. There's not a lot of management. There's no management, at like a traditional real estate play would be.
So why does someone who wants to own land come to you and not a traditional bank or a mortgage company?
Yeah. So that's kind of where we do small deals, and it's not efficient for a local bank or even just a small regional, farm credit union to do what we do. They'll do bigger deals, and and so we basically take their model and do it nationwide on a smaller scale, smaller deals, because again, it's not efficient for them to, they got tens of millions of dollars, they got to deploy it, they got to lend all this money, and they got to originate these loans. We don't have that pressure. We're just small boutique fund. So we take their model. Great. We love what you're doing. We love how passive it is. We love the security of it. And, but we're going to do it. We're going to scale it, and we're going to do it on a smaller, I guess, dollar value basis across, multiple states. Yeah. So they do, Bill. They do what we do, just on a kind of, larger deals. And usually they focus on one county. Let's take, I don't know, just a rural Hickman County, Tennessee, rural Tennessee, within the Nashville MSA, like people own land. Great. There's a bank. You can find a loan, for land, for your recreational land or for your future home site, at the local bank. But some counties you can't, some counties, like it's you're hard pressed to find that loan. So that's what we do.
Can you give me an example of a small deal or a smaller deal?
It's a 20-acre property that's worth, call it $200,000.
Gotcha. Thank you.
Yeah. So if it's less than 500, if it's less than $1 million, if it's less than $500,000, banks aren't going to touch it very often.
I see. And so is this exactly what the Pensacola man was doing?
Yeah, this was one of the strategies he was doing. Mm-hmm. And it's the one that I kind of stuck to. Like, he was doing a variety of things, and I'm kind of like, hey, I kind of saw what he was doing, and he was only doing rural land in the panhandle of Florida, and he had a variety of strategies. So I kind of like, well, number one, I like this one strategy you're doing. And number two, I don't know why you're just staying in Florida. Mm-hmm. Let's do this. Like, we can scale this. And he's like, well, he's kind of old school guy. He's like, I'm just going to stay here in my community. I'm like, that's cool too. I'm going to scale it. So I started co-invested with him, and then built my own portfolio, did Florida, did the Southeast, did a bunch of random other states, and scaled it that way.
Is that where do you live in Florida?
I live in Florida, from Georgia, lived in North Carolina in the military. So Southeast has kind of been my home.
Gotcha. Cool.
Josh Haney with Med South is who introduced us.
That's it.
There you go.
You can edit that out.
We were right. He was a broker, commercial real estate guy, right?
Yeah.
Great guy.
For sure. Mm-hmm.
So how long have you been doing this land? Or that's a different question to how long Land Legacy Fund has existed.
True.
Right.
So land, I started doing land when I right out of the Army. Okay. I jumped in with that developer that I mentioned.
Yep.
But started doing land kind of in parallel, and that was 2017. So I've been doing land since then, and then we started the fund. My partner Eric and I kind of created the foundation of the fund in 2023, and then launched it in January of 24. So we're going on a little over a year and a half now.
Yeah.
Nice.
And it's right about the same time we did Hearthstone.
That's right.
Mm-hmm.
All right. So anybody that's interested in this or is hearing this and like, oh wow, I want to get into this. What does that look like?
Yeah, so it's an evergreen fund. So it's a Reg D 506C fund. So it's accredited investors can, invest in the fund, buy shares in the fund for a minimum investment of $50,000. And so it's a simple, I mean, you talk to me is how you get started. We have a conversation and it's a boutique fund. So it's not like we're some massive organization. It's Eric and I running it. We have a team of people helping us, of course, but we're the, the principals in charge and making decisions. So yeah, talk to me and this conversation starts with, is it a good fit? You know what I mean? Like it's not a good fit for everyone. I talk to a lot of people who are like, Quinn, I kind of want to take more risk. I'm looking for growth. I'm looking for, 2x, 3x, I want to take some risk. I'm like, that's not here. That's not what we do. We don't have that kind of like upside. This is like predictable monthly income type, fixed income type of.
It'd be like investing into the stock, like a mutual fund. Is that what it's called?
Maybe so. But before you get into the model, you threw out some terms here that, with Timmy in the conversation, we need to make sure that we define our terms sometimes.
Yes.
Because they don't teach what an accredited investor is in improv school.
Improv school. They don't.
So we've mentioned this before, but do you remember what an accredited investor is?
No.
Okay. So Reg D 506C, which is, the rules of the SEC, I think, that govern the fund, because essentially he's creating his own security and he can sell his own security.
Right.
Okay. So Reg D 506C is one of the ways you can do that. And under those rules, he can only take accredited investors.
Okay.
All right. What an accredited investor is.
I think I do remember.
Oh, yeah? Come on. Give it to me.
They have a net worth of $1 million at least, or $2 million? $3 million.
It's $1 million.
Yeah.
Outside of their home.
Outside of their home.
They can't count their home. Outside of their home, they've got a net worth of $1 million.
Right.
Or
they earn a certain amount yearly.
Yes.
Or something, which would be
$200,000 a year or $300,000 filed jointly for the last couple of years, and a reasonable expectation that'll continue.
That's right.
And then they have to show, and it's pretty easy to do this, that they're sophisticated enough to understand the risks of the deal.
Right.
Okay.
That would be for the latter, the 200 or 300K.
No, either way, but like you kind of have to just check that box, and most people with that net worth have that kind of sophistication base to do it. If it's a Reg D 506B, which we've done before, our fund too was a C, just like his.
Right.
But that way you can do accredited investors. You can also take sophisticated investors, and sophisticated investors don't qualify under the net worth or income standards, but they still have the sophistication level to understand the risks of the deal.
Gotcha.
Or in other words, they're smart but not so rich.
Yes. Gotcha. Okay.
Yep. So yeah. Okay, good.
Thank you for that.
So Quinn, this was new to me when you shared this with me for the first time. So describe the model of your fund, because it's different than anything that we've ever done. It's different than your normal syndication deal where somebody finds an opportunity, they put a group of investors together, they throw in their equity, they might bring some debt on, and then they buy the property, hold it for 5 to 7 years, increase the value, sell, everybody goes their separate ways. So this is different than that. What's it look like?
Yeah, I think the main way it's different is it's evergreen or open-ended. So as opposed to closed-ended where, hey, we're raising a bunch of money this month, and over the next few months, we're going to be looking for assets to buy. It's much different than that. We have a kind of ongoing pipeline of deals coming in, and investors can kind of come in at their leisure, really at the level of their comfort. They're investing at the speed of their comfort level, basically. So I think that's kind of the main difference, that it's evergreen. I mentioned the $50,000 minimum investment. I think another thing that is that keeps us different than most syndications, we don't have debt. So we don't take in investor capital and then put leverage on top of that to juice returns. I'm a simple guy, so by design we've kept this a super simple not only investment strategy, but also structure, legal structure and investment structure. And so it's simply taking investment dollars, and people, investors, accredited investors, get paid 10% on their money. There's no fees. There's no acquisition fees, management fees, disposition fees. It's a simple 10%. So I like to use $120,000. Someone invests $120,000 times 10% is 12 grand a year, monthly distribution. So that person can expect $1,000 a month passively starting month one. So that's another key thing. It's not like where some syndications kind of like, yeah, distributions start in second quarter, third quarter, or like, whenever we start those distributions in month one. So it's honestly, Bo, as you know, we've talked about before, like I was in a bunch of syndications and I liked certain things about him, and then other things I'm kind of like, well, I'd kind of do that different if I had my own fund. And so this fund is really an opportunity to I guess fix some things, create alignment, have better communication, have better, just a simpler structure, someone you can do. Anyone can just do the math on like exactly what their distributions are going to be. Like no fees will ever erode that. I think that was important to us, and some people kind of raise their eyebrows like, are you sure? I had one guy, he did just that. He invested 120 and he started getting his $1,000 a month. He's kind of like, it worked. I'm like, I'm surprised that you're surprised. Like, yes, it's true, what we're doing. And it's, what else can I tell you about the structure?
Well, let me ask Timmy kind of, let's test his understanding at this point.
Sure.
Okay.
I think I get it, but yeah.
One of our initial episodes way back when was I pitched you a deal that we had just done.
For syndication,
Yeah. And so if you remember, we were talking about internal rate of return.
Yep.
We were talking about equity multiple.
Mm-hmm.
And so most syndication, like anytime we pitch our deals, like we're talking in terms of IRR and equity multiple.
Right.
So you give us your money for 5 years, we're projecting it's going to make you this percent average annually, which is different than cash on cash.
Yes.
And at the end, when it's all over, we're projecting that your equity maybe it's a 1.8 or maybe it's a 2.1. It's 2.1. You've more than doubled your money.
Right.
So you put $1,000 into our deal, and we're going to, by the time it's over, all said, you're going to more than double your money. His model is different.
Yes.
And so he's not talking about internal rate of return. Mm-mm. He's not talking about equity multiples. What do you think the main difference is between the model that we've done most of the time and what he's got here with Legacy Land Fund?
In the model of that syndication deal there, you're really not getting money or seeing that money until that building has sold.
Yeah, you get distributions, but most of it comes at the end for sure.
Right. And so, and when it does come out, it's typically annually, right?
Well, I'd say normal would probably be quarterly distributions is what I see most often.
Right. And it all depends on how successful you are to hit the projection and hopefully go beyond. But the risk is more because there's a lot of things that you can't really aren't in control of, such as cap rates and what's going on in the market or interest rates.
Sure.
COVID.
So in contrast to all that,
with this, it just sounds like, hey, I'm going to invest in this fund, right? And whatever I invest, I don't know if I can say it's guaranteed, but it sounds like I'm guaranteed to get 10% back. It is guaranteed?
It's fixed.
It's fixed. So
yeah, we try to stay away from the G word.
Right.
Yeah.
So I can, yeah. I mean, you can guarantee,
Yeah, don't do it. Don't go Tommy boy. Don't do
it. I could take a dump in a box and mark it guaranteed, but then all you got is a guaranteed piece of shit. But okay, it was like a sneeze.
I know you had to do it.
It's like a sneeze. So anyway, so I put money into this. I'm expecting I'll get 10% back from what I put in, minimum of 50,000 yearly, but I'm getting paid every single month that money, and it's broken up into 12 months.
So in contrast to, you might invest in a traditional syndication model, 5-7 year hold, where you buy something, you sell it at the end. You do that because you're after growth, and cash flow may not be your main thing.
Right.
You're trying to take your money and make it do something else. However, for those people who have the money and they want to generate truly passive cash flow,
Right.
like
It sounds
this is what he's created.
which is pretty incredible, because it sounds like. Go ahead. Sorry.
Well, the other big difference is, and if somebody in one of my deals calls me up right now and says, "Hey, I need my money. I need to get out," that's kind of tough to do. Like, we have to get somebody else in the fund, or we have to value what
Sure.
their share is right now, get somebody else to buy them out, or we have to buy them out, or we just tell them sorry. It's a fairly illiquid investment. What he's created with this evergreen fund, and he hadn't actually said it yet, but you commit your 50,000 or more for a year. So for a year, it stays in the fund. And then whenever you want after that, you can take it out.
Wow.
And at that point, the 10% fixed return a year goes away.
Yeah.
Like, it stops because you've taken your money out of it. But it's just that simple. There's not a sale or a reversion at the end. There's not a refinance and a recapitalization or any of this stuff. They're investing in paper that's backed by land,
Right.
but it creates this monthly cash flow. And instead of taking fees, they get paid on the spread. So if they can make 12% and pay out 10%,
Right.
then whatever the delta is their payment for services.
Right. Okay. No,
Oh,
that-
I need you. You're gonna be my spokesman, man. That was perfect. I
He's so
appreciate
cool.
it. That was great. I'm like tongue tied here on the interview here, but I should have shared all that stuff. It's perfect. I think the distinction's perfect about IRR, where IRR is calculated. You have like your pref return plus your profit split, and combined those two are, hey, your IRR. It's like we don't have that kind of speculation on the backside. No growth opportunity, but also no speculation. So kind of like the pros and cons of that. And then you kind of hit on like who it's for. Like I know I talked about like, hey, it's for folks who aren't really interested in growth. They're like, man, I just kind of want something predictable. Like, I'm okay with 10%. I just want it monthly. Quarterly is not even enough. I want it monthly. I want you in my inbox, my mailbox money monthly. It's okay. So it's not for everyone, but it's for, it's for that. And then you mentioned the liquidity was the last piece. It's like, yeah, this is not like, it's hard for people to stomach. I know it was for me. It's like 3 to 5 years, or at the discretion of the deal sponsor.
Oh, yeah.
Right.
It's kind of like, well, hold on. What's the small print there? Because I've been in deals where it's like, hey, it's 5 years. You said 3 to 5 years. Like, yeah, but it's not a good time to refi. Yeah, it's not a good time to sell right now. COVID hit, whatever. And it's like, oh, shoot, I guess we'll hang out for another year. Let's just cross our fingers and hope. So we tried, that was one piece. Like, let's give some discretion back to the investor.
Yeah.
And let them, like, they can raise their hand. We just had a gentleman do it. He's a year in. He's, his life circumstances changed. He's like, I want my $250,000 back. And so we have enough, cash flow and deal flow to provide that liquidity. So yeah, it's a pretty sweet little model.
It sounds like an alternative to people who invest in like the S&P 500 or the stock market, like Warren Buffett's kind of deal, where he's like, invest your money here. It's on average 10% growth a year, right? And you got enough money in there, your dividends are, pretty much your cash flow or your income to pay what you need to. You got enough money in there, then you're making that back.
Yeah, it's like, I don't know if it's an alternative. Like, we try not to say it's an alternative to really anything that anybody's doing. Because I want people to like diversify, like look at a bunch of asset classes and strategies. There's a bunch of good, great stuff out there. It's just a consideration. Like it's. So I mean, you can go into the stock market. I think it's a better way to say it is probably it's an alternative to like if people want exposure to real estate. Like they have a big portfolio over here and it's doing well or whatever, but they don't have any real estate. And then they start looking at some of these real estate opportunities. It's like, once they really dig into it, they're like, I don't know if I want to be in real estate. Like there's some gotchas in there.
Yeah.
It's like, so I want exposure to real estate, but I really don't want to be a real estate. I kind of just want exposure to it and
Yeah.
realize a return from it, but don't really want the risks associated with real estate.
Right. Right. And I think you're right. Alternative was not, I think, comparable as far as the
Yeah.
you're right. And so which makes me think too that so say I invested $120,000. I like how you did that because that's nice and $1,000 a month. That's good for my brain. That's not good with math. Awesome. So that $1,000, can I choose to have that just drip back into
Like reinvest your dividend kind of idea?
Yeah.
That's a good question.
Yep. Actually, most of our guys do that. Most of our investors are doing that. They're at a place where they're like, look, $1,000 a month extra doesn't really move the needle. But like, let's, I don't, what am I going to do with that 1,000? Quinn, why don't you just keep that, auto reinvest that, and now you're getting a monthly compounding effect on your money. Now your $121,000 is now earning 10%. So it gets pretty interesting over time, and we say it's a 10% return just honestly for simplicity, but it actually ends up being a lot more once you really look at your the compounding effect over an annualized basis.
Yeah. Right.
So yeah, a lot of I should have the stats on the tip of my tongue, but I think it's upwards of like 80% or more have chosen to kind of compound, auto reinvest and compound their distributions.
What is it's low risk, right? What would you say the risk is?
Yeah. Well, like any lending strategy, the risk is default. So borrower default. If somebody stops paying, that's a risk. So that's why we have, our kind of risk mitigation strategies in place. Number one being we're in first lien position. So we have rights to that property, no different than a bank would have a right to your house if you stop paying them, right? We have rights to that property legally. We have the legal right to foreclose on those properties if there's a borrower. We don't want that to happen. And in fact, we're at a zero default rate. We don't want that to happen. We don't want to take back any land. We want to help that borrower continue making their payments. And we have triggers we can pull to kind of help them. So first lien position, and then we also have a low loan to value ratio, which protects us in the case of like we take that property back, but it's not worth what it was 2 or 3 or 4 years ago when we lent on it. Now it's worth 80% of what it's worth. And we want to make sure we have a comfortable low loan to value. Right now we're a little below 50% loan to value, which keeps us safe. So really those two things. So to answer your question, borrower default is the risk, but we guard against that pretty heavily, pretty strong. Yeah.
Yes. LTV, baby. Lala TV.
Yeah, this is like the second or third episode in a row that we've talked about LTV.
I know it's good.
It's come up, so now you might actually remember it.
No, it's clicking. Yeah, it's clicking. Yeah, it's fascinating.
Give me a feel for how your faith has shaped how you do business.
Thank you for that question.
This episode is sponsored in part by Site to Do Business, the ultimate commercial real estate data analysis and mapping tool. Whether you're a seasoned professional or just starting out, Site to Do Business provides the data and insights you need to make informed decisions and close deals faster. Frankly, it's the tool that I use the most in my business. Access comprehensive market analysis, demographic data, and powerful mapping tools like ArcGIS, Placer AI, and flood maps all in one place. Identify the best locations for your clients, analyze market trends, and present your findings with confidence. Don't miss out on this game-changing platform. Visit stdb.com today and see how it can optimize your business. And now back to the show.
Yeah, it's fun because the investors I get to talk to, actually the majority of our investors are vets. So it's a way for us, like for a while, I'm like, man, I need to like do more, give back more. And I'm like, wait a second, what I do daily is, contributing to the well-being of other vets. Let me pour into them. So we just have a lot of conversations. Again, like when we have our conversations initially, it's like, well, why are you investing? Let's explore. Is this even a good opportunity for you? Maybe it's not. So let's look at like what's going on like holistically. So I think in that way, just kind of viewing my, just stewarding the capital well, and also stewarding those relationships with investors as well as I possibly can. I think my faith and has drives me to kind of do to have excellence in those two categories.
Service and stewardship.
Mm-hmm.
Yeah.
In the service of vets.
In the service of vets.
I like it.
It's been great, man. Like I have so many awesome conversations. Like honestly, the straightforwardness of this strategy, like it resonates well with vets. Cause like, oh, I get it. Like it's
right.
I don't have to do, it's not a complicated like syndication structure. It has a bit of complexity, it has a bit of risk, but like it's pretty simple. So we get a lot of like pre-retired folks and retired folks, and because at that in that point in their kind of in their life, they're like, man, I just kind of want some distributions, not in taking a bunch of risks. No different than if you're in the market and you're like, I'm going to shift towards some less risky stuff, some bonds and
treasuries,
treasuries, kind of just shift towards the distribution phase versus high risk, high growth phase.
Yeah, you're right. Like with the many people we've had on, this I've been able to wrap my head around this. I think almost better than most anything else.
Which is interesting to me because he had to really explain this to me for me to get it.
That makes sense. Because yeah,
I've always been thinking about this other, like the model we've used.
Right.
Which, there's 100 different ways to do a syndication, but they all kind of fit in the same bucket.
Sure.
And it's a growth play.
Right.
And hopefully there's distributions and you can, like cash flow is a component, but it's not always the main thing. And I really had to think differently and I was able to understand it pretty quickly, but like he had to get me there.
Right.
Because I was just automatically thinking this other way.
Right.
It was really interesting.
Which makes sense because you're able to wrap your head around complex things and try to, and you've got the skill of being able to explain it to someone in a great way. So when someone presents you with something that really is not too complex, I can see how that take a second for you.
True. If you're closer like me, like I'm so close to it. It's kind of sometimes hard for me to explain because I don't know what other people don't know. So it's like, and then Bo with you, it's kind of like you've done traditional syndications and you're in commercial real estate. It's kind of like is a different model. But I think, but it like when people get it and it's kind of a light bulb moment, they're like, oh, it's kind of a cool niche, why didn't I think of that? And that was my same reaction when I approached it several years back.
When I took this information back to our team at Hearthstone and was sharing with them what Quinn does with Legacy Land Fund and stuff, I was able to get them there. They went through the same process. They had to sort of forget how we normally do things. And so when we realized it was just, like a stabilizing, predictable cash flow play, well, then we started thinking, well, what if and this is kind of how we're thinking about legacy land fund in terms of Hearthstone, but we're investing with deal sponsors.
Right.
So we're looking for internal rates of return that are well up into the teens, at a minimum. We're looking for equity multiples. However, if we can layer in some stable cash flow that's fairly predictable, it brings the overall risk profile of our funds down.
Yeah.
And that can be pretty attractive. It's even led us into the place where we're thinking about, well, what if we have kind of our our traditional funds that are trying to get at least 17-18% internal rate of returns and equity multiples above 2, and that's normal, but now we create a fund that is more lower risk, more cash flow centric, and like legacy land fund could be a big part of that. Maybe we're investing in lower risk deals that don't have these, IRRs where they are, and we just provide more stability. Like, it's just learning about this has started us thinking along those lines of maybe we'd have a different fund that's a different altogether risk profile.
Right. Yeah.
It's a great approach, Bo, because that's, again, with my countless conversations with investors and potential investors, it's like I encourage them to do that. It's like, hey, you can get diversification within real estate. What's the strategy? What's the asset class? What's the market? But it's hard. It's hard for people to vet all those deals, vet all those sponsors, and achieve that diversification. If they go to one source like yours, and they can kind of get it all in one shot, and you've done the vetting, and they trust you and like you, like it's a huge value value add.
So I got a couple questions. This one might have a quicker answer. So and again, I'm thinking of this because I sort of understand stocks, got some in dividends, but I know when I sell stock, there's Uncle Sam's going to take quite a bit of what I have sold. So would it be the same with this? If I'm in for a year and I want to take some money out, what did the taxes look like?
Yeah, not a CPA, so to talk to your own CPA or tax attorney there, but certainly most often you're taxed at ordinary income.
Okay.
Yep.
Okay. Cool. Thanks. And then my other question.
Go ahead. Let's hang out there for just a second.
All right.
Because this is important to know, because there are some differences between this. Because they don't actually take title to a property, but they're lending on it, the income generated is ordinary income. So if you sold stock that you'd held for at least a year,
it's capital gains, right?
It's capital gains, which is at a lower rate, depending on what your tax bracket is.
Sure.
So if it's ordinary income, it's just going to be taxed as ordinary income, not capital gains income. So that's a difference. Another significant difference is the way they invest in land doesn't have some of the tax benefits, like tax sheltering benefits.
Okay.
Like you don't depreciate land.
Right.
So there's not some of those components in this. It's just simple, predictable, stable, 10%.
But if I'm in a state that doesn't have income tax,
well, you're still going to pay federal, but you wouldn't pay the tax in addition.
Oh, I see. Yeah,
the state tax in addition.
I'm still trying to figure this out. That's right.
No, those are all good questions, Timmy. Honestly, I get all those questions. They're all good. And that's, I think, another reason why, like I said, 80% plus have chosen to compound, because they're like no different than a CD, for example. It's like they're earning interest, but they're not paying taxes on it because it's growing and accruing internally with the fund. They're not they're not receiving any cash distributions. So their K1 or their tax, report at the end does not show any income.
Yeah, profit. Yeah.
Yep.
That makes sense. The other question I have is, like, we're talking pretty much on one side of what's going on here, which is as someone who wants to invest in the fund, right? Put my money in the fund. What's on the other side of it? Like, as far as, what do you look for when it comes to land or landowners?
Yeah.
Yeah.
So I think what you're asking is kind of due diligence on us, almost like what kind of deals are we doing? How do we view our pipeline of deals? Is that
Right.
kind of,
And if someone's listening to this and was
yeah.
like, oh, I'd want to talk. Yeah.
There's two layers to like our due diligence, and the first priority is like the collateral, is the land itself. So when we're doing due diligence and we're looking at our pipeline of deals, which we have a strong pipeline of deals, we have to first say like, well, all right, where is this land? Like, what's its value? Is there anything wrong with it? Let's check out the legal and physical access, the slope, any endangered species on it. Like, is this a quality piece of dirt that we can use as collateral for a loan? Just like, so we underwrite the collateral. That's first and foremost. And what's the value? And then it's like, all right, now who's the borrower? If this entity or this individual is paying us back monthly, like what's their story? Let's start there. Like, what are they doing with the land? What do they want it for? Is it an investment? And they want it recreationally? Are they going to build a house on it? Like, what is it? There's so many different reasons why people want the land. And what's their credit score? Can they sign a personal guarantee? Can they afford 20% down? Again, what's the whole story? So what's the land? What's the value? And due diligence on the land, the collateral itself, and then due diligence on the borrower. And we kind of different phases of due diligence within each of those buckets that we walk through. And at any time, if it doesn't like meet our parameters, it's a simple no. Again, because we're an evergreen fund, we have the flexibility. We're not sitting on tens of millions of dollars that we have to, we have to go find these deals. Oh, it didn't meet that criteria. Let's bend our rules a little bit and let's do it. Like, I don't have that stress. Like, I don't want that stress. Like, we intentionally structured this around like, if there's no deals, we're not doing a deal. If there's no deals this week or this month, we're not doing a deal. Like, it's just not, it's okay.
Wow.
Hope that answered your question.
It does. And absolutely. Yeah. Yeah.
Well, somebody who wants to borrow to buy land, like, where do they go? Like, do they reach out to you just the same as an investor would, or is?
They'll know about us because, like, when they bought the guy that sold it, likely knows about us, and so he'll recommend, like, hey, if you buy this, if you don't want to put down $300,000 or $400,000 cash for it, we have a private company that can help you with that, or go to the market, like go to a local bank and see what they can provide, and they're like just saying there might not be great opportunities out there. You're gonna go through the rigmarole of getting that loan, and then all to find out that maybe you don't qualify, or they the whatever. So these guys, Quinn and Eric, Legacy Land Fund, kind of make it easy. So that's kind of how it all originates. But yeah, certain markets, certain sub-markets in rural counties do it. And then some, you can't find it. There's not opportunities for it.
Yeah.
Right. Okay. So it's not just somebody who has land that wants to borrow and their land is collateral. You're also helping the people who potentially are looking to buy land, and you can help them. I see. Yeah.
Yep. When they're buying it, like, we help them buy it.
Yes. Yeah.
Yep.
Okay. Cool. Wow. This is fascinating. Like, really smart. I love how simple it is, and because everyone we talk to, it seems like like you think like you. We're in it. We're like a Marine. Come on, yeah, right. And this is very much like cool, calm, collected. No, I don't want much stress.
I'm of the mindset, like, I don't need my day job to be, stressful and super exciting. Like, I can get my kicks elsewhere, like, let's keep what we're doing safe and see. And back then, it really started when I was looking for places to put my own personal money. Like, shoot, where can I get a return that I understand? And I wasn't smart enough for the stock market. I didn't trust it. I'm kind of like, and I was already in real estate. So I'm like, this is a good, so it really this whole strategy came out of my own pain points of like trying to figure out where to get a safe return, preserve capital, grow wealth, and just steward that well, and if it's backed by land, like it just made sense to me. So it's like, I guess what I'm saying is just more of a, again, it started as like a selfish thing. Like, how do I do this for myself? And then I'm like, oh shoot, let's bring some other people into this. Like could help a lot of people.
Mm-hmm.
Yeah. And when you say you get your kicks elsewhere, I know you're a big family man, and do you have how many kids?
We have 3 kids. I have 2 boys and a girl. My son's 10, and we have twins, boy-girl twins that are 7. So we're busy with their sports and activities and church, and it's a lot of fun.
That's amazing. What are they into? What's the 10-year-old into?
Soccer and dirt biking.
Oh, nice.
Yeah.
Dirt biking. That's awesome.
Well, I love to have like a team sport where you can have the camaraderie of a team and the competitive nature. But I felt the need to have like a recreation, just like recreational, just kind of some freedom there. There's no sport, there's no rules. We can go down any trail or any jump. Like it's just open. And so a little bit of team stuff, a little bit, purely recreational stuff, and it's a sport, I guess. It's yeah, that's what we're into. I want to get them. I'm dying to get them into some scuba diving stuff. I used to do a lot of scuba diving when I had more time, but when they get of age, that's where we're gonna be doing a lot of that. Luckily, we're in Florida; it's not too far away.
That's amazing.
That's what I thought about golf and my kids. I thought, man, I'll get them into golf and I'll get to play more and stuff. Yeah. And all of them were completely not interested in golf. And so now my boys will play some golf. They're 19 and 22, 23, 22, 20, whatever his age is. I get to play golf with them a little bit now, but man, I missed out on a lot of years that I was looking forward to. I thought I could get them into golf, and they were not interested. No,
you don't get interested in golf until you're, like 52 or something. And you're like, my knees. Oh,
you just alienated all the golfers in the audience. So sorry about that.
Well, hey, I'm good at alienating a lot of people in our audience. I love. Never mind. I'm not. Whatever. This and the 7-year-olds, are they? Like, is everybody into dirt biking, or what?
Yeah, getting there. I mean, he's a little young for that. He does have a little 50cc bike that he's great. Like he's actually, I'm like, wow, I didn't have to teach him much. He's great at it. And then my daughter, gymnastics and dance and the girly stuff. We tried her with the sports that involve a ball, and it's not going to happen.
Hey, both of our sisters were gymnasts.
That's right.
Okay.
Yeah,
that's right. And then both of my daughters took them gymnastics yesterday.
Is that right?
Yeah. They're both at Owensboro Gymnasts. I got a 7-year-old and a 3-year-old. The 3-year-old just started a couple months ago. She was so excited. But my 7-year-old girl she's really great at art. Loves art and doing art. She's so into basketball right now, which I don't know where that came from, but
I do.
Yeah, but I totally love it. Actually, it's fun watching. Caitlin, well, we haven't watched since we started watching. Caitlin Clark's been out, with the WNBA, but it's been really fun.
It's cool. It's fun to see like that. You want to push them into certain things, but then like I like to have the freedom to decide, and kind of like it's interesting to see which paths they take. And I think God gives us a bunch of different talents and capabilities, and it's like, man, let's just see how it all unfolds.
It's crazy how different they are too. The two of them, and I'd imagine with twins too. I would imagine they're so different, or maybe they're not. Sometimes twins are a lot the same.
They couldn't be more different. It's crazy, and we're raising them actually. They're the same. There's a room. There's a room. It's like, how are you're not doing. It's just how are you guys twins?
Isn't that crazy? It's so crazy.
Yeah.
It's so crazy. Yeah.
Well, Quinn, at the end of many of our episodes, we like to do a pop quiz for Timmy. Are you interested in asking Timmy a few questions?
Oh, sure. Yeah.
Yeah!
All right, pop quiz. We're going to ask Timmy 5 questions. All right. You're our guest. You'll ask him the first question and we'll alternate from there. So you do question 1, 3, and 5. You can ask Timmy anything we've talked about, or you can just play Stump Timmy and try to ask him anything we haven't talked about. So essentially no rules on the questions you're going to ask him. And that's it. So Quinn, let's kick it off. Question number 1.
Timmy,
Yes.
let's stay with the land theme. You're just gonna how many? So when we buy land, a lot of times we price it like on a per acre basis, right? So it's not just like, oh, that's a $300,000. It's like, oh, it's how much per acre. So acre's a big deal. Acre's obviously a pretty important like measurement in the land space. If I had a square acre, 1 square, so a mile in each direction, 1 square, how many, a square mile, I should say, square mile, a mile in each direction, how many acres is that?
Hey, man.
That's a big space, right? You think about it, you travel down a road for a mile, you do a 90-degree turn left, go another mile, all that area in between. How many acres?
He tried to ask his glasses.
But I'm not connected. Oh man. Oh man. I have. I'm just going to take a guess.
It's a wild guess. I would.
Yeah. So we got a square mile. How many acres are in a square mile is basically it, right?
Yeah. Sorry. Yeah. It's a better
Yeah.
way.
Yeah. How many acres are in a square mile? Whew.
An acre's like a football field, maybe. It's like
Okay.
I mean,
Okay.
Dad's front yard's 3 acres.
nice front yard.
Yeah.
Not if you had to mow it.
Right. That's right.
It's the way to hay it. That's what we did with our lamps.
Okay. I'm going to say my first answer was 100 acre, but that's way too small. So I'm going to say 1,000 acres.
Kind of in between, 640.
640. Okay. All
I
right.
had to look that up.
Right.
Like I didn't know that.
Like
either.
that was
so that was
and
good.
that's what this is for.
Yeah.
Got it wrong.
Got
640.
the brain fart.
640 acres.
Okay. Question 2. Quinn was sharing about their risk mitigation strategies for the fund, and he really mentioned 2 things. He called them triggers, things that they can pull to keep their risk down as they're lending on these parcels of land. Mm-hmm. What were those 2 things?
The collateral, underwriting the collateral, right?
That's a different question.
Oh, okay.
This is,
Right, okay. Wait. Due diligence? Is that...
Well, yeah, there's due diligence that's done, but there's really 2 main things. Now, the due diligence, we had that conversation. That came later. I was thinking about that as question 4 when it comes back to me. But
Okay. I'm not sure because I think I was processing the due diligence, the collateral, the landowner, and this is around the time he was talking about what you're asking. I think.
Yeah, you'll remember this.
Okay.
But they take a first lien position.
Yes. Oh, yeah. Okay. Hold on. First lien position. Yep. And default. That's not it. Okay.
The second one is a low LTV.
A low LT. That's right. 50% or lower, or under 50% most.
Yep.
Yeah. That's right.
Yeah.
Yeah. Okay. Yeah. Good.
This is good. He doesn't normally start off over 2, so this is.
Oh.
Yeah. I'm not. Yeah. Okay.
This is good. All right, Quinn. Question 3.
In your own words, what's an evergreen fund?
It never closes. So I'm familiar with the Hearthstone Capital Fund, where most of those, you got an open fund, people can invest at this time, then it closes and it's done. Evergreen fund, it's always there. So I can invest in it at any time and take my money out after a year. I don't know if that's part of Evergreen, but
Like 7-Eleven. They're not always doing business, but they're always open.
they're always
full credit for that answer. That's good.
That's right. 24/7/11.
I stole that from Boondock Saints, by the way.
Oh, okay. Nice. Nice one. Yeah.
Yeah. Okay. Question 4.
I got that right.
You
though.
get
Bing, bang,
that one
bang.
right.
Yeah.
Yeah.
Okay.
Get your dopamine hit. Okay. All right. He did mention due diligence, and he framed it in the sense that they have 2 layers of due diligence. What
Yes.
were the 2 layers?
One is underwriting the land itself, right? The collateral.
Yep.
And the other one is underwriting the human being behind it.
Yeah, essentially. I mean, you're looking at the land. Like, we're going to loan up to 50% LTV on this land. Does the land actually have the value? Are there issues with the land that could make it like potential landmines that we need to discover before that protect ourselves?
Right.
Wetlands, I think he
Right.
mentioned, certain types of animals that are protected, things
Right,
that could cause
endangered.
problems.
Yep.
Endangered, that's the word.
Right.
And then you got to look at the buyer. Or the borrower.
I think he mentioned like something with the animals or
Yeah.
there's some,
Endangered. What's the word I couldn't pull out? Well, good.
Yes.
Nicely done.
okay, sweet.
All right, Quinn, let's bring him on.
This one, I'm going to stump you on this one. I don't know how you'd ever know this. Maybe a wild guess, but so staying in that kind of that theme, Bo, of the due diligence. One time we did a deal and we didn't do good due diligence, and we were in Florida, and it's like northeastern Florida, kind of north central Florida, and we did a loan on this deal, and we didn't do this was our first time in this market, and we failed to do our thorough due diligence, and there was something on the land that caused a problem for us.
Yeah.
It devalued the land significantly, and we totally missed it.
Okay.
What was it?
Can you give me a clue as far as if it was a living thing?
It's living.
I mean, my only guess would be alligators.
Gopher tortoises.
Gopher tortoises?
Gopher tortoises. It's like a protected species, and they have these burrows, and it costs a crazy amount, like per turtle, to get them removed. And serious repercussions if you remove them yourselves. And we had to hire a consultant, and it was a mess. But it was something, and they were like on the back corner of this property. So when we do deals in Florida, is one of the things we're looking at these days, to state the obvious. But it's gopher tortoises was a complete shock. Anyone doing land in Florida, be careful.
Oh my God. I mean, you're right. Cause I mean, like in the due diligence, unless you know you're looking for it, they're burrowed underground. Right.
Had we walked the full extent of the property, we would have probably seen them and probably questioned them. But maybe not. You're like, oh, I got some cool turtles out here.
Right.
But that was early on when I was investing with my buddy, the Panhandle guy, and we're like doing, we branched out of our Panhandle area and kind of went further east, and we just didn't know.
Yeah.
Land is, I think on the surface it's like simple, but like, man, there's some stuff to look out for.
Right.
And the market's kind of different.
Man,
gopher
shot in the
tortoises typically live for 40 to 60 years in the wild.
Oh man.
However, in managed care or captivity, they can live for 90 years or longer.
Yeah.
One gopher tortoise named Gus, currently living in Nova Scotia Museum of Natural History, is over 100 years old.
Yay, Gus.
And they look like
Gus.
big turtles.
Wow.
Yeah.
Wow. Cool. All right. Great questions. I learned a lot in those questions.
Yeah.
Cool. Well, Quinn, anybody wants to get in contact with you or get involved, where are they going?
Dude, best way, honestly, is just to send me an email to set up a call with me. info@legacylandfund.com. That'll go directly to me. We'll have a call, do some introductions, see if the land's good, the land fund's a good fit.
And I also just signed up for a webinar that you did a couple weeks ago.
Yeah.
How often do you do those?
So, thanks. We send out quarterly reports to our investors, and then coinciding with that report, we'll do a live webinar. Eric and I will do a live webinar and then kind of live Q&A. So it's like, hey, we'll walk through that report. Hey, any questions, anything in here like doesn't make sense. So it's a good opportunity for like current investors and prospective investors to like hear other people's questions. Like, oh, I didn't think to ask that, you know, and kind of just hear it out. So that's quarterly webinars. We'll do that. I guess the next one, October, early October.
If someone wants to be a part of that webinar, where would you send them right now?
Like a month out, we'll send out a link to anyone that's on our list
Gotcha.
to invite them to the webinar.
Gotcha.
Right. And to get on the list, just send you an email.
Yeah.
Okay, great. Cool.
Perfect.
Well, Quinn, this was great.
Oh yeah, man.
I
Thanks
learned-
so much for
Yeah.
sharing your expertise.
Appreciate it. Good to meet you, Timmy. And
Yes,
Bo.
you as well.
Pleasure
Yeah,
to
yeah.
meet you.
You as well. And I'm telling you, Quinn McArthur's is the coolest name we've had. I'm sure you hear that all the time.
Yeah, for sure.
That name is so. It does sound like a bourbon brand or a or a Marvel villain. You know, like, oh, it's amazing. It's amazing.
I didn't hear the end of it being the MacArthur with being in the Army. I didn't hear the end of it. Like, oh, you think you're?
Oh, I
think
bet.
you're-
I hadn't even thought about that.
All right. Well,
Just
cool.
tell them you're kin to the, John MacArthur, theologian and apologist kind of
Yeah,
thing.
we'll go that way with it.
Well, yeah, go that way with it.
Cool. Okay, that episode was like drinking out of a tactical land-secured fire hose. Like if Dave Ramsey's book Full Money Makeover and Tom Clancy's novel Shadow Warriors Inside the Special Forces had a baby and that baby did due diligence, you'd have Quinn McArthur as a baby.
Are you doing all right?
Define all right. I just blacked out and bought 40 acres in rural Arkansas using a VA loan and a compass.
If you enjoyed this episode as much as Timmy enjoyed losing control of his financial future,
I did that a long time ago.
go leave us a 5-star review on Apple Podcasts. It helps us more than you know.
And be sure to subscribe to our newsletter as well as YouTube. Newsletter is subscribe.wgbarron.com. You'll get the latest episodes plus articles on leadership, negotiation, and all the stuff Bo reads at 5 a.m. I don't read them, but I do admire the man who does.
If you want to reclaim your time and scale your CRE business, stop doing $10 an hour tasks in your $1,000 an hour life. Go get yourself an executive assistant from superpowershq.com/commercially speaking
That's
for
right.
top tier executive assistants.
For those in the back, that's superpowershq.com/commercially speaking. Barbara Corcoran. Now, Quinn McArthur would never ask directly, but if you heard a faint whisper behind enemy lines, if a folded napkin slid across your table that simply read, Barbara, your mission, commercially speaking, except that wasn't the wind. That was a Green Beret named Quinn. Of course, he would never do that.
All right, that was some form of awesome right there.
We'll see. All right. Thank you all so much.
Yeah, we'll see you next week.
Yep. Love you, brother.
Love you. Love you, brother.
Bye,
Bye, Alice.